Is it possible, in fact, to find safety in the tech sector when the market is in a pullback? That is what we are talking about today, guys. Here we go. Quality versus quantity. Maybe not so many, but you got to find the best. And yeah, it's a battle of the fittest, and you got to give it time. Patience will pay over time. Let's talk about a few things here. Sean's going to kick us off here and talk a little bit about why it's maybe more about quality than it is about having so many, Sean.
Yeah, you know what? I should probably just try to hide this. So I'm going to show you here a little thing on my sheet without showing you the name of this company. I don't know if you can you zoom in a little bit more? I don't know if you can. But look at these cash amounts here for dividends, right? You go all the way back here to 2013, 95 cents, $1.10, $1.30, $1.40, $1.50, $1.57, $1.63. Okay, that's enough talk about this. But what's the company name? It's IBM, baby. So you want to talk about a tech name? $6.56. I know this is a little bit hard to see, but that's the dividend yield. That's how much they pay, not the yield. The yield's near that 4.5%. But here's the chart for IBM. If you're going to get $7 roughly, right, in a dividend that's been solid, that's been paid, they're a dividend aristocrat. Down here, if this sells off, we're in a market sell-off right now. Does it look like IBM even cares about that sell-off? I mean, when you get back to the downside, if it starts to drop in and you buy this 136, 138, well, remember, if you hold that for a year, they're going to drop $6.50 into your account. So 138 plus 6, you have coverage back down here to 132, bringing you all the way back to April. So for me, I think, IBM, great way to earn some income, collect those dividends, and wait for the market to rebound.
Yeah, exactly. And I'm going to go to the theme of, hey, look, find a stock that has been relatively strong and that is not super expensive from just a price to earnings ratio or forward revenue. So when you start thinking about everyone's fears when it comes to the treasury and certainly inflation as well, and why that's bad for tech stocks because you're talking about future earnings, well, give me a company that's already has solid earnings. Give me a company that is well established. Maybe it's not the sexiest growth name in the world, but it's not about that. So I want something like an Oracle, which at the end of the day, it is relatively inexpensive to compared to some other cloud companies. And then September was such a horrible month. Up until literally the last day in the month, Oracle was testing its highs. So the relative strength is also there as well. And as a matter of fact, as we're rebounding on the first day of October, Oracle, one of the strongest names in the tech sector, up 3.5%. Some of it having to do with how far it's already pulled back. But you're going to want something which has a cheaper valuation and which has shown some signs of not as deep of a pullback as some of the other names. So relative strength, cheaper valuation. Oracle seems like one of those for me.
Stability over time is going to be the key, whether it's through a dividend or simply through a positive history, guys, over years. When you're in a sell-off, yeah, growth stocks are going to get hit first when interest rates are rising. So understand it is a battle of the fittest in this sector. There's not one, but two ideas for safety in the tech group. Here's Miss V.
Hey guys, thank you for sharing this great information. Dear viewers, please subscribe to this channel to see more great videos.